Welcome to today's episode. We're diving deep into the world of Forex trading indicators, essential tools for interpreting market data and making informed decisions. Whether you're a beginner or a seasoned trader, understanding these indicators can significantly enhance your trading effectiveness. Let's explore the different types of Forex trading indicators and how they can be used in various strategies. So, what are Forex trading indicators? These are statistical calculations based on the price, volume, and other macro parameters of a currency pair. They help predict future price movements by providing a graphical representation of market trends in real time, making them invaluable for developing sophisticated trading strategies. Forex trading indicators analyze market conditions using mathematical algorithms, processing historical and current data to generate signals about potential future movements. This helps traders identify whether a market is likely to continue its trend or reverse, crucial for making well-informed decisions. Now, let's dive into the types of Forex trading indicators, each serving different strategic purposes. First, we have trend indicators. These smooth out price data to create a line highlighting the trend direction. Moving averages, MA, are a prime example. Next, momentum indicators like the Relative Strength Index, RSI, help determine the strength of price movement, useful in volatile markets for identifying overbought or oversold conditions. Volume indicators confirm trend strength based on trading volume. For example, high volume with a price increase suggests strong buyer interest. Volatility indicators such as Bollinger Bands adjust based on market volatility, helping analyze potential breakouts. We also have the Moving Average Convergence Divergence, MACD, illustrating the relationship between two moving averages of a currency's price and the stochastic oscillator, comparing a specific closing price to its price range over a certain period, signaling potential reversal points. Combining these indicators, traders can enhance prediction accuracy. For instance, using both leading and lagging indicators provides a comprehensive market view, confirming current trends and anticipating future ones. Now, let's discuss incorporating indicators into a trading strategy. For short-term traders, indicators like the RSI and stochastic oscillator help catch quick price changes, identifying overbought or oversold conditions. Long-term traders benefit from trend-following indicators like the MACD and moving averages, confirming longer-term trends. Combining a momentum indicator with a volume-based indicator yields the best results. For example, pairing the MATD with on-balance volume, OBV, provides a comprehensive market view, confirming trends with substantial trading volume. Finally, continual learning and adaptation are key. Markets evolve, and what works today might not be effective tomorrow. Keeping up with market changes and experimenting with new indicators can enhance trading performance. In conclusion, Forex trading indicators provide valuable insights into market behavior. By understanding and effectively using these indicators, traders can enhance their strategies, minimize risk, and increase potential profits. Remember, no indicator offers 100% accuracy, so combine them with other trading tools and market wisdom for the best results. Thank you for tuning in. If you found this episode helpful, follow us for more insights and strategies. Join our Telegram channel for real-time updates and connect with a community of like-minded traders. Until next time, happy trading!